Tonight we start running a special series of stories looking at how the continent is coping with a fall in oil prices. Are net oil exporters suffering and net oil importers celebrating all the way to the bank? Those are just some of the questions we'll be exploring in the next half hour. Welcome to this edition of Global Business Africa from the Kenyan capital, Nairobi. Here's what else is coming up. A shipment of copper from Zambia into Tanzania runs into trouble given a strike by rail workers. We'll also be looking at the cost in dollar terms of the current power crisis in South Africa. Let's start tonight, however, in two African countries. The rail line between Zambia and Tanzania, which is used to export copper from Africa's two biggest producers, has been shut down. The Tanzania-Zambia Railway Authority, or TAZARA as it's better known, suspended all train operations between the two countries. The Transport Authority said in a statement that it failed to meet most of its operational costs, the bulk of which include expenses for running spares, for locomotives and rolling stock, fuel and salaries. Employees in both countries opted to down their tools. They're demanding to be paid 5 months unpaid salaries. The TAZARA line is a key route for copper exports through the Tanzanian port of Dar es Salaam from Zambia and Africa's biggest copper producer, the Democratic Republic of Congo. And much of the copper from both countries is also moved by road. According to the statement, TAZARA requested its two shareholders to provide further guidance on the matter. Now, the South African utility Eskom has warned that the national grid over there is yet again under severe strain as holidaymakers get back to work and January kicks up into full steam. Eskom carried out controlled power cuts on Friday last week as demand spiked. More blackouts, however, could be on the way as the local economy gets back into action. Now, while the utility is struggling with meagre power reserves and a fairly jittery balancing act, it faces another crisis. It's running out of money. The poor power supply is just adding pressure to Africa's most advanced economy, as Sumitra Naidu reports.
South Africa's energy crisis has cost the economy an estimated $30 billion since 2008. The figure is rising steadily as load shedding is implemented. Big business and the industrial sector is feeling the pain of the interruptions. Despite the need for increased production, Eskom is unable to guarantee a stable power supply at this stage.
Demand in itself is increasing as the economy comes back to full operation after the Christmas break. But secondly, we're doing a lot of maintenance on our generation fleet at the moment. That means that the plant is out of service, and because that plant is out of service, of course, it's not available to run, and our reserve margin is very, very tight.
A poor power supply is adding to the economy's woes. Growth for 2014 is expected to come in at just 1.4%.
The problem is that we have got a very low rate of growth in South Africa, and the concern is that if we don't have a good electricity supply, we are not going to achieve those levels of economic growth that we need. It also has dented the investor perspective of South Africa.
Eskom is spending $100 million a month on diesel to run its open-cycle gas turbines. Diesel reserves are running low as a result of its constrained financial position. Controlled blackouts are expected to continue.
The best advice that we can give our members is that they keep tabs on when the outages are likely to happen, and this is on the website of the local authority and also on the Eskom website, so that when they see that there's going to be an outage, that they can plan it ahead and they can then decide whether they're going to close, what other contingency plans they can put in place, perhaps change the hours that their staff work.
Finance Minister Nhlanhla Nene has called on Eskom to get its house in order urgently. Government has extended its balance sheet to accommodate Eskom, but has warned that it cannot afford any more bailouts.
At the moment, the government and Eskom are in discussion around this, and of course the war room process that has been announced is the process through which the necessary deliberations are taking place. Once a decision has been made, of course, the government will announce it.
It seems there is some light at the end of the tunnel. Construction on the new Medupi power plant is finally complete. The facility will have to undergo some testing in the next month and will come online soon, which means that it will ease up strain on the national grid. However, it will be some time before the plant is fully operational. Sumitra Naidu, CCTV, Johannesburg.
Now, barely a year ago, private equity firms raised a reported $3.5 billion for investment right across Africa. That was a cumulative figure for 2013. Now, the fundraising boom, however, seems to be continuing quite strongly, with news coming out this week that Helios alone has raised over $1 billion for investment across the continent. So where exactly in this arms race is Kalar Holdings, formerly known as Citadel Capital? Earlier today, I spoke to Karim Sadek, Kalar's managing director in charge of logistics and infrastructure, to get a feel for how the company had survived the 2008 fiscal crisis, the 2011 uprising in Egypt, and now this invasion of PE funds.
Ability to exit and reinvest ceased in our part of the world since 2008, okay, which is not necessarily the case for other players. 2008 was a global phenomenon, it was the financial crisis, but then just as we were coming out of it, we were hit with the revolutions
in
Tunisia
2011.
Yeah. So the stock markets and strategic exits have become so rare and so difficult to attain that this notion of recycling cash is no longer the case. That's number one. Number two, you're also starting from the premises that we were a traditional private equity company, which we were not. We traditionally do not operate funds. We operate case by case and then build equity at the holding level for a specific industry and expand on that. So that's number, it's open-ended, okay. Number two, we have never come out with any commitments on exits, time-wise, okay, because we were not operating on funds basis. Third, our contribution, any given investment we've been involved in, the least, and this is the refining project in Egypt, which is a $1.2 billion ticket, was 10% and has since increased up to 30-40%, which is again not what you would see from a GP in a private equity, where his own balance sheet would be at 2-3% at best. Yeah. And fourth, we've been doing substantially greenfields. Now, we can argue about the timing of it, all that, but the reality is, your initial question that we were a traditional private equity like Helios or Cargill or anyone, I tend to disagree with the premise.
But now that the markets in the Middle East are essentially heading back up, Dubai, of course, accepting the crashes that we've seen related to oil in the last couple of months. Egypt was up, what, 34% in the last year alone. Is that window for strategic exits back open again?
It is, it definitely is. But as a corporate, you're taking a longer term view. When you took, I mean, this is not, a shirt that you're changing every day. We did invest substantial effort and resources and money for that transformation. The other issue also that comes with the change is also much more focused management, in the sense, we're trying to be extremely disciplined in what we've committed to our shareholders. Is, we are spending much more time now doing less deals, being much more selective. To start with, anything outside the 5 disclosed sectors or / industries, we don't even.
You don't think about it.
We don't even think about it. We don't chase it. And even within those 5 sectors, we are extremely selective, and that's why we've done very little in terms of with a commitment to our shareholders to really focus on maximizing what we have now before a second wave comes in.
Let's move on to Tunisia now. It will issue $1.75 billion worth of dollar-denominated bonds and Islamic Sukuk bonds as well this year, as it seeks funds to kickstart its economic growth once again. The country will issue $750 million worth of bonds at the end of January, in addition to a bunch of other Sukuks that will hit the market to the tune of about $1 billion in the third quarter of the year. The dollar-denominated issue will be for 10-year bonds, with its political transition to democracy more or less complete after last year's elections. Tunisia's new government will now have to turn its attention to economic reforms and revival 4 years after the toppling of President Zine El Abidine Ben Ali. Tunisia needs about $4.2 billion to finance its 2015 budget, and part of that money has to come from foreign sources. Multilateral lenders have also pledged to aid the North African state. Nigeria's central bank has relaxed rules on buying and selling foreign exchange, which were blamed for essentially wiping out, nuking, if you will, the currency trading market in the country. Banks now have 72 hours to use dollars bought in the interbank market before they have to sell them back to the regulator. That's an extension from the previous period of just 48 hours. Nigeria is Africa's biggest single crude oil producer. It tightened rules on foreign currency trading as the naira slumped following a dip in global oil prices. In retaliation, the central bank raised interest rates to a record 13% in November last year to stem the outflow of capital. The finance minister, Ngozi Okonjo-Iweala, proposed cutting the budget outlay by 8%. Interbank trading dried up last month after the bank introduced these new, tighter rules. Analysts say the naira will still remain under pressure, however, because the forces that are weakening the currency are fundamental. They're citing the fall in the oil price, and they say that is what is mainly affecting the naira. Now then, let's move on to Somalia. After years of conflict and war, the interim Juba administration in southern Somalia is finally getting around to upgrading key infrastructure in and around the southern port of Kismayo. Ever since it took over power, the local administration has laid out its infrastructure plan, established a central bank, revived the presidential palace and other key government installations. This latest revival also includes a refurbished Ministry of Transport, Posts and Telecommunications. Now, this has been described as a milestone for Kismayo, since the local population can now get access to vital government documents, licenses and passes. Local drivers and vehicle owners have been given a 40-day deadline to apply for a driving license and other vehicle passes and permits. Ideally, this should go quite the long way in professionalizing the transport industry by pushing out non-permit holders off the road.
We as Jubaland, we will return the former rules and regulations of the state, such as the new number plates to be given to each and every vehicle, as well as road licenses and stickers from the ministry.
If Jubaland used to be governed by militias previously, now it's not that time. And we are a federal state which is ready. Its community and the public shall contact the Ministry of Transport, Posts and Telecommunication for the logbook and driving license.
All right, let's make a quick run through equity markets here for you. Another day of mixed performance across the board. Losses seen in West Africa. Positive numbers coming through elsewhere. However, thing is, there are some interesting markets coming out of Reuters. It's citing an anonymous source saying that Tullow, the Africa-focused oil explorer, is due to cut jobs. A staffing review, apparently, according to this anonymous source, has been launched in response, of course, to the slump in oil prices. We'll keep a very close eye on this story and follow it up for you with some more details in tomorrow's broadcast. Coming up, we'll be looking at a special series on how the continent is coping with a slump in oil prices. And fashion gets techie. We'll introduce you to a future where what you wear may alert you to see a doctor. Africa is 77 of the world's 10 fastest growing economies. We help you make sense of the fast-changing African business landscape. We take you where the business is happening. Global Business, weekdays at this time on CCTV Africa.
Sustainable development and a commitment to developing partnerships with Africa. Some of the key phrases already used at the Africa Global Business Forum here in Dubai.
There is a need for a predictable environment in which investors have to put their money.
Welcome back to the program. You're still watching Global Business Africa. Let's talk about Heineken. It's betting on Ethiopia's middle class to fuel the expansion of its sales in a country where it has set up an entirely new plant. Ethiopia's average annual beer consumption is about 5 litres per capita. That's about half the average level for sub-Saharan Africa, excluding South Africa. And in some cases, it offers quite a bit of room for expansion. Heineken Africa's African and Middle East regional president, Siapa Mistra, said Ethiopians are used to fermented drinks, and they also do grow quite a bit of barley, which is essential in beer making. Ethiopia's economy is growing at about 9% a year, and its debut $1 billion Eurobond was oversubscribed last month. Heineken has brought numerous plants in Africa and built 2, one in Nigeria in the year 2000, another in South Africa in 2008. It's been gradually ramping up its new plant in Ethiopia since July last year. Elsewhere, Zimbabwe's cash-strapped government is seeking a lifeline from revenues collected from its toll gates. The Transport Ministry over there is set to roll out 32 new toll gates in a move that will see, ideally, revenues jump from last year's $132 million to $220 million. But of late, motorists are complaining of the deplorable state of roads in Zimbabwe, and those are only made worse by heavy rains. Zimbabwe's National Road Agency, which administers these toll gates, has come under sharp criticism from locals who question whether revenues from the toll gates are even used properly. In 2014, toll fees went up by 100%, but they still remain lower than those in South Africa. Zimbabwe's government says that at least 10 of the new toll gates will be operational within the first half of the year.
The revenue they're getting now is enough to fix the current potholes, but nothing is being done.
So far, we've had so many toll gates, but the rains came, there's so many potholes, and we're not sure where the money is going. So I think the government must reciprocate by also doing our roads much better than they are at the moment.
Now, the government of the Indian Ocean island of Madagascar has resigned amid growing criticism and violent protests over the cabinet's handling of recurring power blackouts. The president, Henri Rajoelinarimampianina, made the announcement in a decree released on Monday night. He said he was in the process of appointing an entirely new government. The government of the Prime Minister, Roger Kolo, has come under heavy fire for its handling of power failures. Angry citizens have taken to the streets recently to protest against rolling blackouts, which have become a lot more frequent ever since the new president came to power a year ago. The energy minister, Richard Fihenena, was fired 2 months ago for his inability to solve the problem. Just 15% of the island is actually hooked up to the national grid. The president doesn't have a majority representation in parliament. He appointed Kolo as premier in April 2014, 5 months after elections brought to an end a political crisis sparked by a coup in 2009. Now then, in the wake of falling oil prices, Africa's biggest economy is facing a tough time funding its national budget. Authorities in Nigeria are now turning more to tax revenues other than what they get from oil to finance the budget, but analysts say that will simply not be enough. CCTV's Deji Badmus starts our special series of reports looking at how African economies are coping with the fall in oil prices on What's Hot Tonight.
If there's one country badly hit by the continued fall in global oil prices, it is Africa's largest oil producer, Nigeria. The country's national budget is usually benchmarked on the price of oil per barrel. The seemingly never-ending fall in prices has forced the government to cut down the benchmark for this year's budget twice. The latest benchmark is $65 per barrel, far below the current global price of oil.
The government can no longer earn enough revenue to fund the budgets as it is today. We are looking at possibly a shortfall of revenue about 1.9 trillion. A budget of 4.2 trillion with a shortfall of about 1.9 trillion simply means the government has to borrow. I think that's the only way out. Because even if you adjust the benchmark to current oil price of about $48, you are not still going to have enough revenue to meet even the current portion of the budget, which is about 2.66 trillion. So the government has no choice as it stands.
But the government is not thinking of borrowing. It is rather turning to taxation, hoping to raise enough from taxes to fund the budget.
So we have decided that we are not going to go and borrow our way out of this, but we are going to take the necessary measures to weather this without further exacerbating our debt.
Apart from initiating expenditure cuts, The government has introduced several new measures to generate revenue. One of such is what it calls luxury tax, aimed at taxing luxury goods from private jets, luxury cars to champagne.
Most of these measures are designed to kick in not now, but towards the beginning of the second quarter of 2015. And we believe that they will considerably boost non-oil revenues in comparison to oil revenues.
But not everyone believes these measures will go far enough to fund the budget.
You need time to build tax structures that is pervasive. Today we have a weak tax structure. So you need time to build a tax framework that will expand the people in the tax dragnet. I don't think that can be achieved in a matter of months.
The government has made no pretenses this is likely going to be a tough year for Africa's largest economy. It has asked Nigerians to brace up as its austerity measures kick in. But if oil prices don't pick up soon enough, Nigeria will surely face a tough time funding its national budget. Deji Badmo, CCTV, Lagos, Nigeria.
Commodity prices, a fairly interesting story developing at the moment. The rout in crude oil still very much in progress. The margins between WTI and Brent crude essentially shrinking as well, and that's got a few interesting commentators wondering whether or not that reduces the incentive for East Coast refiners in the US to actually bother even getting crude from their own markets. Coming up next, we'll be looking at an acute shortage of gas across Niger. Welcome back to the program. Now, the world's largest statistics portal, Statista, estimates that wearable tech as a market might be worth over $7 billion this year. But some companies are moving beyond just smart wristbands and watches and Google Glass and so on, and they're seizing business opportunities in the data collected by the wearable tech you wear.
Many devices on the market can tell you how far you run. Sensoria, a Seattle-based company, has developed a fitness smart sock that measures how well you run. Equipped with textile sensors and an anklet weighing 28 grams, the smart sock relays information wirelessly to a mobile phone app, which tells you if you need to correct your stride, and is priced at $199.
By actually having the right positioning for the accelerometer and combining that same technology with our unique and proprietary textile sensing technology, we have three ways basically to detect whether I have taken a step or not.
Turning footprints into dollars, the company delivered its smart socks to its first group of crowdfunding backers over the Christmas holiday season. But making hardware isn't the only space where companies see the potential for making money. Some are developing software to boost health in the workplace. Chronic disease is responsible for more than half of the deaths in the world, while cardiovascular disease is responsible for more than 20 million deaths worldwide. Another Seattle-based company has developed a website and mobile apps that help companies track wellness, an effort to cut healthcare costs by keeping workers in shape while encouraging daily use of wearable technology. 100 companies with 10,000 or more employees use Limeade services, with a number of multinational corporations among them.
When we see improvements in biometric values or health status or just engagement at work or preventive care screenings, that's our biggest success. So first and foremost, it's customer success is our success.
Limeade makes money by charging employers monthly for its service. Sensoria's CEO believes the future is unlimited for wearable tech and data collection.
A patient is going to be able to go to his doctor and say, hey doctor, my knee hurts, and here's my 3 months of data. This is what I've done. before I got injured, right? So it's going to be a more quantified conversation.
But wearables still have a long way to go. A recent PricewaterhouseCoopers survey found 21% of respondents own a wearable tech device. Of those, only half wear them daily. Chris Casquejo, CCTV, Seattle.
Now in West Africa, Niger's capital of Niamey has been facing quite the acute shortage of cooking gas, or LPG, in recent weeks. Tonight on Grassroots, Leslie Mirungu takes a look at the current situation, which has forced locals to revert to traditional sources of fuel as alternatives to gas.
Niger's capital Niamey has in recent weeks been faced by a shortage of cooking gas. This is after the main refinery, which is in the country's east in the Zinder region, warned of the shortage pending maintenance. Gas consumers like Asani Ide are worried as now locals are forced to seek alternatives in traditional sources of energy like coal and firewood.
They got us used to gas and now there is a major shortage. Unfortunately, we are going to resort to traditional sources of energy, which are wood and coal.
The gas crisis has been worsened by disputes between the refining company of Zinder and the Nigerian petroleum products company Sonidep. The refining company of Zinder, which is largely owned by the China National Petroleum Corporation, complains it is owed millions of dollars by Niger's Sonidep, which operates all gas and fuel stations in Niger. It is evident that Niger's petroleum industry is the only one to suffer from the dispute. The impact of the crisis has trickled down from the major gas companies to even the lowest gas seller.
The gas shortage has completely ruined our business. Gas supplying companies are always telling us to go and come back later. But as you can see, nothing changes.
Niger, which wholly depends on gas supplies from Nigeria, produces uranium for export. But the country says it has no immediate plans to make the switch to nuclear energy as an alternative source of energy. Leslie Mirungu, CCTV.
Right then, here's what we're working on for tomorrow's program. We'll continue, of course, with this series looking at the effect that these lower oil prices are having on economies, albeit in South Africa. Petrol prices over there have been cut 5 times since the middle of last year. Will it continue? Maybe, maybe not. And we'll also be in Ethiopia, where apparently a new habit among Ethiopian savers is providing quite a few interesting profit avenues for local banks as well. Now then, a little earlier in the bulletin, we focused on what the Nigerian economy has been doing, at least the central bank extending that window for selling back foreign currency to 72 hours. The Naira didn't particularly care, down 1.4% against the American dollar. Apparently no fresh USD supply in the market today. We'll see how that pans out later on tomorrow. But that's it for this edition of the program. Do remember you can send your feedback to globalbusinessafrica@cctv.com. And of course, when we're not on air, Facebook and Twitter are your ports of call. The news continues over there 24/7. See you tomorrow. I'm Ramanya.